Ladies and gentlemen, stop what you're doing. The oil market just moved. You saw the headline. U.S. strikes Iranian targets. Iran threatens retaliation. Oil prices surge. You think that's the story? It's not. The price is never the story. The story is what the price is telling you about what's breaking underneath. Right now, crude is trading at levels we haven't seen in months. The talking heads will tell you this is about geopolitics. This is about tension in the Strait of Hormuz. This is about supply risk. And they're right. But they're only seeing the surface. What they're not telling you is that this move was prepared. This move was expected. And the people who positioned for it 6 months ago are about to extract wealth from everyone who thought peace was possible. Let me walk you through what actually happened. The U.S. conducted airstrikes on Iranian military installations. Iran responded with threats to close the Strait of Hormuz. 20% of the world's oil flows through that strait. 20%. In a normal market, that threat would cause a spike, a sharp move up, and a pullback as cooler heads prevail. That's the pattern. But this time, the pattern broke. The oil price moved up, and it didn't come back down. It stayed elevated. It consolidated. And now it's moving higher again. This is not volatility. This is repricing. The market is telling you that something structural has changed. The Strait of Hormuz is no longer just a risk premium. It is now a certainty premium. Think about what that means. For decades, the oil market operated under an assumption. The assumption was that Iran would rattle its saber but never swing it, that the U.S. would patrol the Gulf but never fully engage, that Saudi Arabia and the UAE would pump enough oil to compensate for any Iranian disruption. That was the deal. That was the equilibrium. But equilibriums don't last forever. They last until someone realizes they have more to gain by breaking them than by maintaining them. Iran looked at the chessboard. They looked at their leverage. They control the Strait of Hormuz. They have the ability to choke off 1/5 of global oil supply with naval mines, with drones, with missiles positioned on the coastline. For years, they didn't use that leverage because the cost was too high. Sanctions, isolation, military strikes. But something changed. The sanctions are already maxed out. The isolation is already complete. And the military strikes just started happening anyway. So what exactly does Iran have to lose now? The answer is nothing. And when you have nothing to lose, you have everything to gain by using your leverage. Here's where it gets interesting. Iran doesn't need to actually close the strait. They just need to make the insurance market believe they might. Oil tankers moving through the Strait of Hormuz are insured by a handful of underwriters in London. War risk insurance, piracy insurance. The premiums on those policies just doubled. In some cases, they tripled. The underwriters are telling ship owners we cannot guarantee safe passage. If you want to move crude through the strait, you pay a fortune or you go around. And going around means adding 2 weeks to the voyage. 2 weeks of extra fuel costs, 2 weeks of delayed delivery, 2 weeks where that oil is locked up at sea instead of being refined into gasoline. This is the supply chain shock that nobody is talking about. The headlines scream about the price of crude, but crude is just the input. What matters is the output. Gasoline, diesel, jet fuel. These are the products that move the real economy. And the refineries that produce these products are not sitting on months of inventory. They operate on just-in-time delivery. They assume that crude will arrive when needed. But what happens when the crude is stuck at sea? What happens when the tanker that was supposed to dock in Houston next week is now rerouting around the Cape of Good Hope and won't arrive until the week after? The refinery runs low. It cuts production. The price of gasoline at the pump starts climbing, and the consumer starts panicking. Now let's talk about who saw this coming. The major oil producers, Saudi Arabia, the UAE, Russia. These are not passive actors. These are strategic players with intelligence networks that rival the CIA. They knew that U.S.-Iran tensions were escalating. They knew that a military confrontation was becoming more likely, and they made a decision. They chose not to increase production. Think about that. The oil price is surging, demand is high, and the swing producers, the ones with spare capacity, are keeping their taps closed. Why? Because they benefit from high prices. Because they can see that the Strait of Hormuz risk is not going away. Because they understand that this is not a temporary spike. This is a structural repricing of the commodity that powers civilization. Saudi Arabia is particularly interesting here. For decades, they played the role of the swing producer. When prices got too high, they opened the tap and flooded the market to bring prices down. When prices got too low, they cut production to stabilize the floor. They were the central bank of oil. But that role is expensive. It means sacrificing revenue to maintain order. It means keeping the West happy at the expense of your own treasury. And Saudi Arabia is done playing that game. They have been telegraphing this for months. The public investment fund, the diversification away from oil dependency, the spending on mega projects. All of this requires cash, lots of cash. And cash comes from high oil prices. So when the US and Iran went to war, Saudi Arabia didn't ride to the rescue. They sat back and watched the price climb. They are letting the crisis do the work for them. Russia is even more brazen. They are under sanctions. They are cut off from Western financial systems. Their oil is selling at a discount because Western buyers won't touch it. But that's starting to change. As the Strait of Hormuz becomes unreliable, as Middle Eastern crude becomes harder to access, buyers are getting desperate. They are going back to Russia. They are paying higher prices. They are ignoring the sanctions because they need the barrels. And Russia is quietly rebuilding its export infrastructure. New pipelines to China, new refining capacity in India, new shipping routes through the Arctic. They are positioning themselves as the alternative to Middle Eastern oil. And every day that the US-Iran conflict continues, their position strengthens. This brings us to the real trap. The West assumed that oil was abundant, that the market was deep and liquid, that there were always alternatives. But those alternatives are disappearing. Venezuelan production is collapsing. Libyan output is unreliable. Nigerian supply is plagued by theft and sabotage. The shale boom in the US is plateauing. The easy oil has been drilled. The new wells are more expensive and less productive. And now the Middle East, the region with the largest reserves and the lowest production costs, is on fire. The industrial world is being squeezed from multiple directions at once. And the squeeze is just beginning. Let me explain what this looks like in practice. Airlines are already feeling it. Jet fuel prices are spiking. They have two choices: pass the cost to passengers by raising ticket prices, or absorb the cost and destroy their margins. Either way, air travel becomes more expensive. Fewer people fly. Tourism collapses. Business travel shrinks. Now extend that logic to shipping. Container ships run on bunker fuel. When oil prices surge, so does the cost of moving goods across oceans. Retailers have to pay more to import products. They raise prices. Consumers pull back. Demand drops. The economy slows. This is the transmission mechanism. A crisis in the Strait of Hormuz doesn't stay contained in the energy sector. It ripples through every supply chain on the planet. And here's the kicker. The central banks can't fix this. The Federal Reserve can't print oil. The European Central Bank can't conjure barrels out of thin air. When inflation is driven by monetary expansion, you can tighten policy and slow demand. But when inflation is driven by a physical supply shock, tightening policy just makes it worse. You crush demand, you crash the economy. But the oil price stays elevated because the supply is still constrained. This is stagflation, slow growth, high inflation. And no policy tools that work. The 1970s all over again. Except this time the debt levels are exponentially higher. This time the financial system is far more fragile. This time there's no Paul Volcker waiting in the wings to save the day. Now, let's talk about the timeline. The oil market is forward-looking. It doesn't care what happened yesterday. It cares what happens tomorrow. And what happens tomorrow depends on two variables. Does Iran escalate further? And does the US back down? If Iran closes the Strait of Hormuz even partially, even temporarily, the oil price doesn't just spike. It explodes. We're talking $150. We're talking $200. We're talking about a level where the global economy cannot function. If the U.S. responds with overwhelming force and reopens the strait by sheer military might, the price comes down. But that scenario requires a level of commitment and coordination that seems unlikely. The U.S. military is stretched thin. Public support for another Middle Eastern war is non-existent. The window for decisive action is closing. What's more likely is a grinding stalemate. Periodic skirmishes, tanker seizures, drone attacks, naval standoffs. Not quite war, not quite peace. Just enough chaos to keep the insurance premiums high. Just enough uncertainty to keep the oil price elevated. And in this environment, the producers win. The consumers lose. Wealth flows from west to east, from importers to exporters, from the indebted nations to the resource-rich nations. This is not a bug. This is a feature. This is financial warfare dressed up as geopolitics. Here's what nobody wants to admit. The US-Iran conflict is not a mistake. It's not an accident. It's a choice. Both sides chose this path because both sides believe they have something to gain. Iran gains leverage, the ability to extract concessions, the ability to hurt its enemies economically without firing a shot. The US gains a justification, a reason to maintain its military presence in the Gulf, a threat to point to when it needs to rally allies or increase defense spending. But the side effect of these choices is an oil shock. And an oil shock is the one thing the fragile global economy cannot absorb right now. So what does this mean for you? It means that the cost of everything is about to go up, not because of demand, because of supply. And supply shocks don't resolve quickly. They grind, they persist, they force adaptation. The economy that emerges on the other side of this will look different. More regional, less globalized, more expensive, less efficient. The era of cheap energy is over. The era of cheap goods is over. The era of predictable supply chains is over. What replaces it is uncertainty, volatility, and a brutal competition for scarce resources. The oil price is not just a number on a screen, it is a signal, a warning, a message from the future. And the message is clear. The system that powered the last 50 years of growth is breaking. The assumptions that underpinned globalization are being tested. And the winners of the next era will be those who control the physical world. Not the digital world, not the financial world, the physical world. The wells, the refineries, the tankers, the pipelines, the nations that produce energy will dictate terms to the nations that consume it. This is the new hierarchy. This is the new reality. And if you think this crisis will blow over, if you think cooler heads will prevail, if you think diplomacy will save the day, then you're not paying attention. The trap has already been sprung. The dominoes are already falling. The oil market is telling you that something has fundamentally changed. The only question is whether you're listening. Because by the time the mainstream media admits what's happening, by the time the politicians acknowledge the severity, it will already be too late. The repricing will be complete. The wealth will have transferred. And the world you thought you understood will be gone. Stay alert. This crisis will blow over. If you think cooler heads will prevail, if you think diplomacy will save the day, then you're not paying attention. The trap has already been sprung. The dominoes are already falling. The oil market is telling you that something has fundamentally changed. The only question is whether you're listening. Because by the time the mainstream media admits what's happening, by the time the politicians acknowledge the severity, it will already be too late. The repricing will be complete. The wealth will have transferred. And the world you thought you understood will be gone. Stay alert. This crisis will blow over. If you think cooler heads will prevail, if you think diplomacy will save the day, then you're not paying attention. The trap has already been sprung. The dominoes are already falling. The oil market is telling you that something has fundamentally changed. The only question is whether you're listening. Because by the time the mainstream media admits what's happening, by the time the politicians acknowledge the severity, it will already be too late. The repricing will be complete. The wealth will have transferred. And the world you thought you understood will be gone. Stay alert.